Welcome back to our series of Investment Philosophy 101. This is the second video in a two-part series. In the first, I laid the foundation for an investing landscape where we went back and we looked at the history of the markets and we took a close look at the successes and failures, predominantly failures of individual investors, retail investors, professional investors, academics, and consultants, and shared some information that we feel like every investor should be aware of before they embark on an investment philosophy or asset management strategy of their own. So in this video, I want to delve a little bit deeper into some of what has worked in investing and how Two West crafts our own internal evidence-based approach to investing. So I want to take a look at exactly what is evidence. What does it mean when I say an evidence-based approach to investing? Ultimately, it means that I want to be able to sit across the table from a client and support the conclusions that we've made to justify the asset allocation inside their portfolio. I want all of our clients to feel comfortable with and know and understand that these decisions are supported by strong evidence, and not just evidence that would point to last week or last year or the year before that, but evidence that has withstood the test of time. So we ask ourselves, what is evidence? Well, we look to something that has worked in the past. We want to see 1 year, 3 year, 5 year. Can we look at the mutual fund or the investment or maybe the geography that worked last year and say, well, that worked last year, so we ought to buy that in our portfolio for this year. We ought to weight that more heavily in our asset allocation strategy. Does that work? Well, it's certainly a piece of evidence. Now the question is how strong is it? Is it testable? Has it repeated over a lengthy enough period of time? So for some of you watching this video, you can think back to maybe some stats class in college or high school, and you'll vaguely recall that this is measurable. This is the scientific method. If we have a large enough data set, we can test the hypotheses. If we know that the sun has come up for a billion years, day in and day out, well, the hypothesis that the sun will come up tomorrow can be proven out with a very, very high degree of confidence. We can do the same thing in investing. If we look back at the last 10, 20, 30, 40, 50, 100 years of investing, 200, 300 years of investing, in some instances we have that much data to look at, we can draw conclusions about what we expect in the future that are statistically significant, and we can prove that with the math. We want to be able to share with our clients, to show to our clients that we're making decisions in a manner that's consistent with everything that we've come to know and understand about the investing landscape over not just the last year or 5 years, but hundreds of years. So yes, we do look at what has worked in the past. Over the last 1 year, 3 year, 5 years, yes, but we place a much heavier weighting on what has worked over the last 10, 20, 30, 50, 100, 200, 300 years. And then we like to see something that's testable. When we ask ourselves what has worked in investing, we want to ask ourselves if we can test that hypothesis. Can we look back at the data set and say, okay, well, this worked in the past. What's the likelihood that that's going to work in the future? And we look for data that's statistically significant and robust. We also look for data that's cross-sectional, meaning that it hasn't just worked in one instance, but it's worked across industries, it's worked across geographies, and it's worked across asset classes. What we know about these parameters is that when we find something that has worked for a significant period of time, when we find something that's testable, when we find something that's statistically significant, when we find something that's robust, cross-sectional, that has worked across industry, geography, asset class, so on and so forth, that data typically is presented in an academic journal. So if you know much about the world of academia, you know that every junior professor in the country is clamoring to get tenure. How do you get tenure in the world of academia? Well, you get published. How do you get published? Well, you draft an article and you submit it for peer review, meaning that something that you know to be true, your findings that you've observed in the history of investing data that you've drawn out, well, now it's been reviewed and examined by your peers to determine whether or not that's meaningful, whether or not that's true, whether or not that will repeat itself in the future. And if it's deemed to be quality research, it will be published in a top-tier academic journal. So when you see the bullet points laid out on this slide here, which we call strong form evidence, when all of these are met, you'll typically see that published in an academic journal. One of the primary examples of that, which here's a chart that shows what has worked in the past, value stocks. This is a phenomenon that's widely known by our industry. Value stocks have a tendency to deliver a return premium to investors and have had over the last 70 years. This data was presented by Eugene Fama, who won a Nobel Prize for this research in 2013, and shows the effects of segmenting a universe of stocks by small value, large value, small growth, and large value. And what we know to be true about the world of investing based on this data is that small stocks have a tendency to outperform, and value stocks have a tendency to outperform. So at the margin, this data is strong enough to support a tilting in that direction of our investing portfolios. And you can observe that here and again with a chart that I shared in our investing landscape video that was provided by one of our partners, Morningstar, that shows the history of the markets. They segment their equities by large cap, which is the light blue line here, and small cap. So the notion that small caps outperform is very, very well known, and that's something that we can take advantage of when we're building our portfolios on behalf of our clients. If we invest in a universe of equities to capture the long-term return of about 10%, and then ever so tactically as appropriate for an individual investor's risk tolerance, tilt that towards small cap stocks, we know from history that's likely to set the odds in our favor of capturing a higher return in the future. So let's look at another testable hypothesis. When I use that term testable, I'm recalling on a scientific method which many of our viewers are familiar with from a 6th grade science class. Well, that begins with a hypothesis. And one of the hypotheses that I'm sure many of investors have heard of is the old adage, sell in May and go away. If you look back at the history of the markets, June, July, August have historically been volatile months, and that has produced a mentality among investors that it's wise just to get their money out of that market during that time period. Okay, great, sell in May and go away. Well, we can test that. What has happened historically if we look back and we begin in 1926, if we look at that data that's presented by Morningstar, and we begin in 1926 with a dollar that was invested, and we remove it from the market in May, and we reallocate in October, every year for 90 years in a row, what does that yield? Well, we see here in this chart exactly what that yields. If we implement that sell in May and go away strategy, $1 yields 1.2 million 90 years later, versus a buy and hold approach that yields 5.3 million. So here we have an old adage that I've heard hundreds of times, and I still hear investors use today. I hear on CNBC, and I still get questions about it. Clearly debunked, and yet it persists. And that's why we require an evidence-based approach to investing with such exacting standards. That's why we require statistically robust research. That's why we require evidence that's cross-sectional. That's why we require evidence that's been peer-reviewed and tested and published in an academic journal. When we say we have an evidence-based approach, that's what that means. It means that we've looked at something in a manner that's proven itself over time. And we refer to this as strong form evidence. There's a lot of other forms of evidence out there. 1 year, 3 year, 5 year returns. That's evidence. That's evidence of prior success. It just doesn't happen to be testable in a manner that gives us enough confidence to put money to work on behalf of our clients. So we differentiate what we know from what we can predict, and what we can predict is based on an evidence-based approach that's either strong form evidence or weak form evidence. So broadly speaking, those are the parameters that guide our approach and that help us answer hundreds of investing-related questions that we field on behalf of our clients every day. And the next time we get to looking at your portfolio and start to wonder about something that you heard on CNBC, I would encourage you to use this framework. Okay, is this testable? Do I have any basis to form a belief around the notion that this will repeat itself in the future? And if it doesn't meet these criteria, I would argue no. We don't have sufficient basis for this to inform our decisions on a go forward basis, and therefore we would reject it and make our decisions based upon what we do know to work in the field of investing. So that is a very brief overview on what the term evidence-based investing means to us. Please hit us back with questions, comments. We love to have these conversations, and I'll just thank you again for your time.